Oil prices are surging, as we mentioned. Take a look at West Texas Intermediate, up today 12% or $9.81 to over $90. Let's go to Rick Rule on this. He's president and CEO at Rule Investment Media, and he joins us to talk some more about what's going on. Rick, as you saw, West Texas above $90 a barrel right now. Walk me through the fallout of what happens if, as predicted by Qatar's energy minister, Gulf production dead stops.
Well, in the very near term, basically 50% of the world's export crude go through the Straits of Hormuz. So countries like Japan and China are particularly affected. I don't know how long this will last. I'm not a geopolitical or military analyst, but it points to a deeper structural problem in the oil and gas market, which has to do with about $1 billion a day in sustaining capital investments that haven't been being made. It leaves us very, very vulnerable to shocks like this.
What kind of investments?
The sustaining capital investments are things like recompleting wells who are past their prime, drilling makeup wells in shale plays like the Western Canadian Sedimentary Basin or the Permian. The truth is that the oil industry, in particular state-controlled firms like PDVSA and Pemex, have been underinvesting substantially. It doesn't necessarily impact their production in 2026, but further out, 2028, 2029, it has what is probably an irreversible impact.
How long would it take if the Gulf production does stop within a few days for something like that to restart? What does that look like?
Oh, that's truly ugly. If you take down Gulf production, never mind sustaining capital investments, there needs to be all kinds of new capital investments. I think that's off the table, really. We'll have to make do the best we can with regards to the Straits of Hormuz. As I say, I'm no military analyst, so I don't want to be a doomsayer. I don't know how long the shutdown will last.
The U.S., of course, has reserves like most countries do. Would that be an option for Washington in offsetting the spiking cost of gas right now?
I think it absolutely will. It'll become a political issue in the United States. The United States is a very large liquefied natural gas exporter, and I suspect that it would be in Trump's political interest to divert what is currently export loadings to the U.S. market, should that become necessary.
And do you think that is a play that could perhaps hear about soon?
I'm sorry, I didn't hear you.
Do you think that is something that would be decided on soon?
I don't know the answer to that. I think that the political damage from what's going on in the Gulf hasn't been extreme enough that Mr. Trump would need to take that step. But certainly he would do whatever he had to do to maintain his own political popularity in the United States, including probably deprive our export partners of the gas that they've come to become dependent on.
As you know, Canadians are also looking at spiking prices at the pump. And I'm wondering if Canada can fill part of the gap for the U.S., or would they even be needed to do that, considering, as you say, there's enough in the U.S. if they turned away from exporting some of it?
We would have needed both countries to debottleneck our infrastructure, including things like the Keystone Pipeline and Northeastern Access pipelines, in order for that to have any near-term impact. My own belief is that U.S. supplies are adequate, but the Canadians really need to look at the opportunity they have, particularly in the Pacific Rim, where not too long ago, the belief in Canada was that there was, quote, no business case for Canadian natural gas. The circumstance that we're in today points out that there probably is an extraordinary business case for Canadian hydrocarbons on world markets.
Let's talk about Venezuela as well for a moment. A lot of oil came from that country after the U.S. moved in. Is that easy enough to refine? Is that useful at this point in the U.S.?
It's useful in the U.S. because the U.S. refiners were geared up for heavy crude from Venezuela and Mexico before political difficulties deprived us of that crude. They're less marketable on global markets. One needs to understand that as ugly as the deferral of sustaining capital investments in the rest of the world has been, it's been particularly ugly in Venezuela, where despite having the largest reserves in the world, production has fallen by 85% in 20 years.
Okay, let me ask you about oil stocks for a moment. I'm wondering, with the big push up in what we've seen over the last week, would you chase oil stocks right now?
It depends on whether you own them or not. If you're going to own them for the next 10 years, there are structural reasons why the oil market goes higher. For people who've been acting in a contrarian sense for the last 18 months and already have some oil stocks in their portfolio, they probably don't need to chase them. Loving Exxon at 100 US a share is not the same as loving Exxon at 170 US a share. There's a news trade now that's begun to supersede the fundamental trade.
And do you think the price of oil will sustain itself after being so depressed last year?
I do. I believe, provided that we can sort this circumstance in the Middle East out, that there are adequate supplies in the near term for oil prices to decline back into the U.S. $60 to $65 a barrel level. That circumstance changes, however, 2 or 3 years out, where the previous mentioned deferral of sustaining capital investments means that we will ration by price in the longer term.
All right, Rick Rule, I'm going to leave it there, sir, but appreciate you joining us on the program. Thank you.